Real estate market gauge for the following 2 years, 2024 to 2026. Real estate market expectations for the next 2 years, 2025 to 2026. The U.S. real estate market has been on a wild ride lately. Taking off home costs energized by generally low home loan rates made a craze of purchaser movement. Be that as it may, the tide is by all accounts turning. Increasing loan fees have cooled purchaser excitement, prompting more slow deals and inquiries regarding what's in store. While the flood of late years may be directing, specialists foresee a future with steadier home cost appreciation, possibly for certain territorial varieties. Contract rates are probably going to stay raised, contrasted with notable lows, influencing moderateness for certain purchasers. In any case, a continuous expansion in lodging stock could offer more space to breathe for those still on the lookout. We should figure out a portion of the master expectations for the following 2 years in the U.S. real estate market. We'll investigate what the future holds at home costs, contract rates, and lodging stock. Real estate market expectations for the following 2 years. Hot or not? Home value figure. Home costs have been a significant concentration in the U.S. real estate market, with many contemplating whether the vertical pattern will proceed. Specialists offer a scope of forecasts, with some subtlety relying upon the area. Unassuming appreciation. Numerous investigators expect a shift from emotional cost increments to a more safe speed of appreciation, possibly around 3 to 5% yearly. This is because of the consolidated impact of higher costs and a possible expansion of inaccessible homes. 2024. Home costs are supposed to develop by around 3% year-over-year by Q4 2024, driven by supported requests and restricted stock. Expectations for 2025 recommend a more vigorous cost increment of around 5% year-over-year by Q4. This development is credited to rejuvenated purchaser premiums as home loan rates decline, making home buys more reasonable for some. Restricted value plunges. A couple of specialists recommend a chance of slight cost dunks in a few overheated markets, especially in the event that home loan rates keep on climbing. In any case, these downfalls are probably going to be minor and limited. Territorial varieties. Remember that the real estate market isn't a stone monument. Expectations might fluctuate essentially depending upon the particular locale. Regions with solid work development and restricted stock could see more steady or even marginally rising costs, while more slow development districts could encounter a more articulated cooling impact. The figure for home loan rates. Contract rates have been a vital driver of the real estate market free-for-all, and their new ascent has essentially influenced reasonableness. Specialists offer a few experiences into what homebuyers can expect for the following 2 years. Rates liable to remain raised. The agreement among most experts is that home loan rates will probably stay over their memorable lows. The typical 30-year fixed contract rate is projected to be somewhere in the range of 6.1% and 6.8% toward the finish of 2024. Potential for changes. While a supported vertical pattern is normal, a few specialists foresee there could be times of slight rate vacillations. Significant conjectures demonstrate rates settling around 6.2%, for certain sources recommending they could plunge into the high 5% territory, relying upon monetary circumstances. This could be impacted by financial information deliveries or strategy changes by the central bank. 2025 and then some. Home loan rates are supposed to proceed with their descending pattern, possibly averaging somewhere in the range of 5.9% and 6.1%. The Home Loan Investors Affiliation (MBA) expects rates could tumble to around 5.8% before that year's over. Looking further ahead, a few experts foresee that home loan rates could drop to around 5% by mid-2026, with assumptions for slow upgrades going on into a long time as financial circumstances balance out and expansion is held under control. Influence on reasonableness. Higher home loan rates will without a doubt influence moderateness for certain purchasers. Be that as it may, a few investigators recommend this could ultimately prompt a more offset market with expanded stock as certain purchasers might decide to trust that rates will descend. Estimate for lodging stock. Lodging stock has been a significant trouble spot for purchasers lately. Low stock and furious rivalry made offering wars and drove costs up. Specialists offer a few bits of knowledge into what's not too far off for lodging stock. Steady increment anticipated. Numerous experts foresee a progressive expansion in accessible homes available to be purchased throughout the following 2 years. This could be because of a few elements. 1. Moving business sector elements. Higher financing costs may cause property holders who secured super low rates to wait. Be that as it may, others confronting life changes or monetary tensions could choose to sell, adding to the stock. New development. While not a significant transient arrangement, an expansion in the new home development movement could ultimately add to a more adjusted stock level. Territorial varieties. Like home costs, the accessibility of homes available to be purchased will probably shift by area. Regions with solid work markets and restricted lodging choices could see a slower ascent in stock contrasted with business sectors with a cooling lodging area. Not a purchaser's heaven, yet overseeing expectations is significant. While an expansion in stock is a positive sign, it's probably not going to swing the pendulum totally to a fast-moving business sector in the following 2 years. The general inventory is probably going to stay underneath pre-pandemic levels. For purchasers, this could mean a less mad purchasing experience, with possibly additional opportunities for consideration. Nonetheless, rivalry could in any case exist, particularly for beneficial properties. Expectations for territorial market varieties. The U.S. real estate market is a complicated embroidery woven from various provincial patterns. While public conjectures offer an overall viewpoint, huge varieties are normal across various pieces of the country. This is the very thing that specialists anticipate for local business sectors, Sun Belt versus Upper East/Midwest. The Sun Belt locale, South and Southwest, is probably going to proceed with development, yet possibly at a slower speed. This is because of variables like positive climate, open positions drawing in relocation, and a bigger pool of existing homes. Conversely, the Upper East and Midwest could encounter a more articulated cooling impact, with possibly lower value appreciation or even slight dunks in certain regions, especially those with slow work development. Beachfront versus non-beachfront. The reasonableness hole among seaside and non-waterfront regions is probably going to extend. Increasing loan fees could cost out certain purchasers in customarily costly waterfront markets, prompting a more adjusted market or even cost remedies. On the other hand, non-seaside regions with a lower typical cost for many everyday items could proceed with consistent development. Hot versus cold business sectors. Hot business sectors that accomplished dangerous cost floods lately could see a more critical control in value development or even slight downfalls. On the other hand, advertisers that haven't seen emotional cost increments could encounter more steady or even marginally rising costs, particularly assuming they have solid nearby economies. Keep in mind that these are expansive provincial patterns, and explicit urban communities inside every district could digress from them in light of nearby factors like work market strength, new development movement, and in general lodging stock. Most recent real estate market depiction, August 2024. Ongoing information by NER gives a more clear image of the ongoing real estate economic situation. Existing home deals blurred 2.5% in August to an occasionally changed yearly pace of 3.86 million. Deals slid 4.2% from 1 year prior. The middle existing home deals cost rose 3.1% from August 2023 to $416,700, the 14th back-to-back month of year-over-year cost increments. Every one of the 4 U.S. locales posted cost increments. Curiously, the complete lodging stock toward the finish of August was 1.35 million units, up 0.7% from July and 22.7% from 1 year prior, 1.1 million. The unsold stock sits at a 4.2-month supply at the pace of the ongoing deal, up from 4.1 months in July and 3.3 months in August 2023. NAR Boss Business Analyst Lawrence Yun noted. Home deals were disheartening again in August, yet the new improvement of lower contract rates combined with expanding stock is a strong blend that will give the climate to deals to move higher in ongoing months, said NAR Boss Financial Specialist Lawrence Yun. The home purchasing process, from the underlying inquiry to getting the house keys, ordinarily requires a while. Tips to purchase and sell a home in these next 2 years. Purchasers, overcoming the market in higher rate times. The ascent in contract rates presents difficulties for purchasers, yet there are still procedures to explore this market. Get pre-supported. Knowing your financial plan forthright is critical. Getting pre-supported for a home loan provides you with an unmistakable image of your moderateness territory and reinforces your proposition. Consider flexible rate home loans. ARMs offer a lower beginning financing cost contrasted with fixed-rate contracts. In any case, know that the rate can change after a set period, possibly affecting your regularly scheduled installments. Cautiously assess your monetary dependability and long-haul plans prior to thinking about an ARM. Investigate monetary help projects. For first-time homebuyers, different taxpayer-supported initiatives and upfront installment help drives can assist with spanning the moderation hole. Research nearby and state projects to check whether you qualify. Thank you for watching and supporting the Nai Tao Real Estate channel. If you have any questions about buying, selling, or investing in residential income properties, feel free to reach out. Don't forget to like, comment, and subscribe for more valuable real estate content. Thank you.